And the great thing about self-storage is, you have these institutions that are public traded companies that are operating them for you. So when we do our self-storages, it's not, Bill and Ben self-storage. It's being operated by Public Storage or Extra Space, one of the big ones. And these guys have been around since the 70s, and they know the game and they know it very well. They're the largest in the world. And who better to partner up with when, two big operators that know how to operate this stuff.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guests are Bill Kanatas and Ben Salzberg with Self-Storage Developers. In just a minute, we're going to speak with Bill Kanatas and Ben Salzberg about self-storage from dirt to doors. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Bill Kanatas and Ben Salzberg. Welcome to CREPN Radio.
Thank you, Darren. I really appreciate you having us on her show.
Thank you.
Well, I'm looking forward to our conversation, but before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. You want me to start, Ben?
Go ahead.
It's great when you have two partners. We arm wrestle every morning. Who's going to talk first, right? So usually Ben wins, but today's my day, I guess. I've been a real estate investor for about 30 years or so. Got involved early on in my career in finance. I owned a residential mortgage company. And from there, we sprung into doing commercial mortgages as a private lender, and then began to develop single-family homes where we'd buy tracts of land and we would entitle it, and then we'd bring in the water, sewer, and streets and subdivide the lots and sell them to individual home builders. And from there, we started doing strip centers and office buildings, office condos. And through our career, we've developed car washes, the tunnel car washes. We had a few of them in our portfolio before we sold them in 2021. And that opened up the doors to get into self-storage, where I've been in self-storage now with Ben since 2021.
Yeah. And my background, I'm an engineer. I'm a mechanical engineer. I have a MBA specializing in quality Six Sigma. I'm also a teacher in education, teaching the problem-solving techniques. I've been doing that for over 20 years. Worked for Amtrak, ADP, big corporations, consulted with the CEOs. Done a lot of commercial projects, buildings, develop negotiations for Amtrak and Boeing building downtown Chicago. Been doing commercial real estate for over 20 years. A managing broker, and met Bill. He and I started this self-storage venture. We're very experienced individuals, especially with my background, engineering background, and Bill's background in finance. We are an incredible team, and we have great people behind us. And Darren, I appreciate you starting this off, this podcast, saying about insurance and risk tolerance, and that's what self storage is that risk tolerance, right? in the industry, and that's why we got into it. We analyzed the market before we actually did it, and we're like, oh my god, this is like a fantastic type of asset class to hold. And Bill can talk more about that, but it's something that goes hand in hand with insurance as far as risk tolerance goes, and as far as owning like a property in an asset class like self storage.
Got it. So you both sound like you've had a lot of experience in real estate. I'm curious, how is it that you landed on self storage?
I think right after the car washes, and it was during the pandemic, Ben and I were looking at what other opportunities are out there. During the pandemic, we had to close down the car washes because we had stay-at-home order from the state of Illinois. So you had to shut down operations for a while, and obviously that wasn't great for business. But we were looking at other industries as well, and take hotels as an example. It's another thing that was getting shut down, right? But self storage did the exact opposite thing. It was booming. And why is that? Because people started working from home and they started taking stuff out of their offices. People were actually buying different houses, maybe bigger houses, because they wanted to put a home office. And the one thing, and it wasn't the first time we were looking at self storage. We were looking at self storage about 10 years ago and looked at it and said, boy, this would be a good asset class we should look into. But we didn't focus on it because we were just in the process of doing the car washes. But once COVID came around, we started looking at it very seriously, started doing the underwriting, and really got a chance to understand it, and loved it. And the great thing about self storage is, you have these institutions that are a public traded companies that are operating them for you. So when we do our self storages, it's not Bill and Ben self storage. It's being operated by Public Storage or Extra Space, one of the big ones. And these guys have been around since the 70s, and they know the game and they know it very well. They're the largest in the world, and who better to partner up with when two big operators that know how to operate this stuff.
Got it. So the model then is you own the property, but you then have the operator uh, do all the sales and management of the property. Is
That
that right?
that's correct. We usually have the REITs, do like public storage or extra space. They will manage, they will operate it for us. They have a very large outreach and marketing. And so, as far as filling them up and managing the process, and when they have a known process because they've been doing it for so long, so we definitely have them manage our projects, our real estate.
Right. And this
Got
is
it.
not a franchise model. So don't think of it as, a Subway or a Jimmy John's or even a McDonald's where you're the franchisee and they train your employees and you go through the whole system. This is a true third party operator. So the employees are public storage or extra space employees. The great thing about that is, somebody is sick in the morning and they can't come to work. Obviously, your store manager, then they already have a regional manager in place or somebody that's, rotating, looking at all the stores getting trained, they could just pop into their systems. So their systems are, out in California as an example for public storage, and everything is centrally located and every computer is synchronized. So an employee can go from store to store and nothing really changes.
Got it. Got it.
And, and,
So
yeah.
I'm sorry. Go ahead.
And what's nice about having a REIT to manage your place as well, they know how it's performing, and the REITs usually buy these facilities because we're a merchant building building on one side of it. We'll hold it depending on our own investors if they want us to hold it. But the REITs, when they manage it, they see how well it's doing, and they usually buy these asset classes in the long run. So that's the exit strategy, right? So we have an exit strategy. We build these facilities. We look at the pockets. We analyze them, and so it's a very good model that we have for an investor.
Got it. So the question I've got. So you guys primarily develop new self storage buildings. Is that correct?
Correct.
We
Okay.
we do we do develop. We have done conversions as well.
Okay.
Convert like a Burlington Coat factory. We converted. It's operating very well right now. It's an A-class facility, 120,000 square feet, about 900 units. But there are pockets in the industry that there's absolutely no building that you can convert. And these
Right.
are the pockets that we seek out. And those pockets are going to they do extremely well because of the analytics that are found in those pockets. And unlike other people, that we have the skills and abilities, and we didn't talk about the tax benefits and how we structure things around taxes. These are all a lot of stuff that we look at and focus on, and we analyze and we seek out these great land to develop, but we will also seek out opportunity to repurpose. We're not against that. But a lot of the stuff that there is no property in that land, and we love the area, and then you have to build those dirt to doors. And so Bill and I have been focusing on dirt to doors because there are a lot of areas that are not touched.
Got it. So when you do that, knowing that you're going to be working with the REIT or the operator there, is there a uh, conversation with the operator prior to inking the deal to make sure that that's something fits in their model that they want to? I mean, do you basically have a tenant signed up before you sign on the loan to go forward and build?
Yeah, again, they're not a tenant for you, right? So it's not like you have a master lease with Public Storage and they're your tenant, like you would have a Walgreens lease as an example, or a CVS or a Starbucks. They're just a management company and operates it. So we don't have any agreement with them in advance that they're interested in buying it. That's a whole different department, and they're going to look at the pro forma like anything else when they purchase an asset. But beforehand, we do have a management agreement signed. Before they even take it on, they have to take it through committee and get it approved. They got to make sure that they don't have any other sites that might be in direct competition in the surrounding area. And more than that, they also check what are the current market rates today and will it be successful? If Ben and I just love this site and we're like, oh my gosh, it's the greatest site. We just have to develop it. And then, our consultants say it's the greatest thing. We got to develop it, but it gets to public storage. And they say, guys, we just don't believe that you're going to hit $2 a square foot in this market. Now, if you think you can make money at $1.20, then we'd be happy to take it on for you. But don't be thinking this is a $2 market when it's not. And that's where it's really, really valuable having operators already there, right? Because there's only so much research Ben and I can do. You can walk into a facility and ask them what they charge for rent so you can gauge it for yourself. But you really need to work with a trusted operator that has operations within that 3 mile or 5 mile radius, whatever it is, that can give you, accurate information. What was today's rate and how long did it take to get there, if that makes sense?
Yeah, that's exactly kind of what I was trying to feel out there was, if it was just the two of you identifying spots, I would think, well, you could certainly do a good job, but having the credibility of a company like you said, self storage or extra space that
Yeah,
has all
public
the
storage.
technology and all the data behind
Correct.
it that
Correct.
supports it would certainly uh, you know endorse and suggest that you're going to be successful and so successful that they're probably it sounds like their long-term goal is to buy the property period, so they're wanting to make sure it's successful. uh,
Yeah.
that to me sounds like a great resource to have.
Sure.
We
I,
also have a board. We also, sorry, Bill. We also have a support board at our company. We have a lot of people with 10, 20 years, 30 years, 40 years experience actually. Together, probably over 100 years
for
experience
sure.
on our board. So it's not just us. We go to our board. We talk about, what do you think of these properties? What's your thoughts? We get input on that. So there's a lot of filters we have right now.
Right. Yeah.
Got
And
it.
these are all self storage specifically people on the board, not just real estate, investors and brokers.
Got it. So once you identify a spot, you've got the blessing of the management company that's going to manage the space for you and hopefully buy it if you decide to exit. Um, how tell me a little bit about where do we go from there? Are your plans, are they kind of pre-drawn? I mean, is this kind of like a lot size, building size, pull the trigger, get building, or how? Tell me a little bit about the process and give us some timeline.
Sure. So, we first, look for markets, for underserved markets, to be specific, and we acquire the land, but we do everything from taking it through, site acquisition, entitlements, environmental cleanup if it's necessary, design, construction, and then obviously the final lease up prior to stabilization. But once we identify a piece of property, then Ben and I internally with our team will look at all the demographics. So things that we look at, if I'll give you an example, we look at population. You like to have an area that's densely populated within 3 miles, 75,000 or more would be great. The household medium income of 75,000 or more would also be great. But then we look at something that's the per capita. And what that is, the amount of population in that 3 mile radius, how many square feet are in demand right now for self storage and what is already existing in the market. And if it's low, typically Ben and I would like to do it under 7 feet per square foot. We have one right now that we're developing. I think we're in the low fours on that one. We have another one that's out of state in St. Louis that's in the mid threes. We have one in California that's in the low fours. These are all great markets. It means that there's a demand. So once we decide, the two of us with our team internal, that we like it, then we take it to our consulting team. They do some research on it. They say, hey guys, this looks like a good market. And then we model it ourselves to see what we think the income is going to be in the expenses, how long we think the ramp up is going to be. And then while we're doing that, we reach out to either Public Storage or Extra Space, ask them if they're interested in doing third party management. They have to look at it to make sure it's not a conflict with anything else they might have in the area. Then they'll take it to their board and get it approved as an actual site to manage as a third party. And once they do that, they create their own models and they tell us, and then we fact check what they've given us versus what we think it's going to be. And this is the crucial point. Again, as I said earlier, if we think we're going to get $2, a foot, and they're saying, guys, that's great. Unfortunately, we're having seasonality. Let me give you an example. Let's pretend it's near a university, and you're going to be losing some people during the summer, or maybe you have some exterior doors where maybe some boaters are using it, and then they're going to take their boat out for the summer. This is the information that you're really getting from people on the ground, the regional managers. Also, we might think that 10 by 10s are the best locker, and our architect says, hey, you can get a lot more 10 by 10s in here and make more money. And they may say, you know what, that sounds great, but 10 by 10s is just not selling here. Can you give us more 10 by 15s? Can you give us some more 10 by 30s? Can you give us some more climate, less climate? This is where you really need somebody on the ground in that market to tell you what's really moving and selling and what the demand is. And that's where guys like Public or Extra are really just, key to our success here.
So, with a partner like Public Storage or Self Storage, are you do you feel confident in going anywhere on the map, or do you have like a territory that you guys try and stay within?
So we analyze the whole country, for placement of these facilities. Now remember, they don't tell us where to go. We have to ask. We analyze it ourselves. Go back. We have very close relationships with Public Storage or Extra Space in other companies too. Darren, we have close relationships with other self storage facilities
Yeah,
out there. I mean, there's many other ones except Public
sure.
and Extra
There's Cube
Space.
Smart, Store Smart. I
Q
mean,
Smart,
there's
we have
right,
relationships with everyone.
right.
So, we analyze, but we are everywhere. Where Bill just said we're in California. We're looking at property even in Portland. We looked everywhere. Texas. Location doesn't matter for us as far as where it's at. It's just the analytics and make sure that it's a good
Right.
market.
And both Public and Extra have told us no. Where Ben and I said, "Oh, this is a good area," and then they take it up the flag, or they look at it or analyze it, and they'll tell us no. In fact, just at a dinner probably less than 2 weeks ago, we found a great site in California. I loved it. The analytics were perfect. The numbers were great. I was so excited. I told Ben about this. We were both excited, and we had dinner with Public Storage, and we said, "Hey, what do you think about this site? Let's keep it hush hush." And he said, "Well, I got to tell you, we have one going up about 2 blocks away from there, so you probably don't want to tie that property under contract." So if I didn't make that phone call, we'd spend money tying up the property, getting it under contract to find out later. So we do a lot of our work up front before we tie up anything.
Yeah, and I think that would be great value to have that the ability to call and have those conversations to make sure you're not jumping into a place that's already saturated or surprise surprise there's three going up around you kind of thing.
Right,
That's good.
right.
That's good. So the preliminary identifying the site and the conversation you're having with the managers, I get that. So now let's say you pick a site and all lights are green. Uh, Walk us through the next steps. Are you raising capital? Are you getting bank loans? How are you? Are you picking contractors?
Yeah,
Walk us
that's
through.
really a great question. So Ben and I like to, well, let me rephrase that. Maybe not like to, but we feel compelled to spend our money up front and take that risk off the table for the investor. So earlier in the conversation, we were talking about insurance risks and other risks. So we'll tie up the property ourselves. So we'll put the earnest money down. We will then spend money, obviously, with the attorneys if it needs to get rezoned or whatever we need to do during that process. Typically, tie up a property for about 180 days. We often close before the 180 days. We just don't know how long it's going to take. You got to talk to the village and make sure that they're open for that. You may walk into a village, and even though you think you might be able to get it entitled, or maybe even if it's entitled by right, but it needs a special use, and you don't think they're going to give it to you, these are conversations you got to have up front with people. We spend money with the architects to start doing some preliminary designs to show with the villages. Once they say yes, then we go to ask the architect to do full prints, which take about 60 days. And then you got a structural engineer involved, you got a civil engineer involved, you got boring samples involved. So you can have about $200,000 tied up into a site probably before you even close on it. And the goal for us is then once is we know this is going to happen, we start syndicating our deals. So we go to the marketplace and we look for accredited investors that are interested in investing in self storage, typically $100,000 or more. Or we might have a family office or a fund that might be interested in pulling the trigger and doing the full capital call. And each one of these buildings is about $15 million, and that would include your interest reserves and operational reserve losses, because it takes a couple of years to stabilize this, where it's paying off your taxes and your mortgage and servicing the debt. And prior to that, you have a lot of money that you're obviously putting out and not getting back. So it's about a $15 million project. We typically would go to a traditional lender in the marketplace, and they would give us a 70% loan to cost. And then the other 30%, we'd go to the marketplace to private investors to raise that. And Ben and I would also take a part of that capital stack to show that we have money side by side with the investors, as well as us being on the GP side, the general partnership.
Got it. Timeline from once you've got the green light from the managers to getting the doors open. What's an average?
So if we're doing ground up, we say about 12 months. Again, depends on where it is. If it's in the Midwest and you're starting in November and you have some winter conditions, that might get pressed. The good news is the steel for the building are being manufactured somewhere else, so they're just being delivered and erected. That takes a lot of time down. So your general contract will say 10 to 12 months. We say 12 months. And then the same thing with the lockers. I mean, the interior doors are manufactured somewhere else, and they typically would send their whole crew out from Georgia or wherever they're located to just build it. So it's not like our general contractor has to reinvent the wheel and install each door individually. They send their own crews. The same thing with the iron. The steel, the red iron, whatever it is that we're going to use for this particular building. Those are all done by subs that manufacture it themselves.
Got it. And just you mentioned steel and that. Any issues with any of these tariffs? Does that any of that come into play in your cost modeling?
Ben, you want to take that one?
Well, there are a lot of companies have pre-bought a lot of steel, so we make sure that we secure some of these steel right now. And we do get a lot of the steel is American steel, so a lot of those tariffs is not hit on that, and so we kind
Yeah.
of try to mitigate that. But I also want to say we didn't hit yet, because we definitely help high income investors shield taxes and you build generation growth. And I know Bill, has a lot of knowledge on the taxes, and I would like him to talk more about, kind of what differentiates us a little bit.
Oh, sure. So, Similar to the car washes when we were doing it, we have the accelerated depreciation. You got the bonus depreciation, you got the 179D, which is for energy efficiencies. And Ben and I just did a study recently on a self-storage facility that we're going to start building next month. We're closing on the land. And the consultants came back with about a 26 to 27% of the equity that can be written off in the first year. So that's a big deal for investors that have passive income that they're looking for losses. In addition to that first year, you have the operational losses because I mentioned earlier you're running in the negative for the first couple of years. So 100% of all losses go to the investors. Ben and I don't get any of that as a general partnership. And we also have a third party administrator that's involved in all of our transactions. And they basically have financial oversight on us in the deal, as well as doing the reporting to the investors. So it's, between having a public storage or extra space, a publicly traded REIT operating it for it, you have a third party administrator kind of watching the financials of the company. And then you got experienced self storage developers. I think this is a great investment opportunity for investors. And now you got the taxes. We just talked to a family office recently. I think it was last week, and they're looking at it. Their accountant is now talking to our accountant to understand what their needs are for 2026 and how we can help them place some of their capital in 2026 because they have a lot of income and taxable to them in 2026. I just talked to another family office 2 days ago who have a problem. They have $14 million they need to deploy this year and $18 million next year. So we are working with high net worth individuals or family offices that do have that tax implication, but we're also working with people that have money in their IRA account. So if somebody wants to, through their IRA account, if it's self-directed, they can put it into one of our deals as long as it's 100,000 or more, and then that money grows tax-free for them because it's in their IRA account. And I'm not an accountant. I'm not trying to give anybody any tax advice either. But assuming that once the money comes in there, you can borrow against your policy and use that money as well. So there's a lot of strategies that are good
Yeah.
for investors. And it doesn't have to be a family office worth $1 billion. It could be, like I said, my sister-in-law, I'll give you an example. She has a great 401k, and she's looking to put money from her 401k. We've had family and friends that have given us money through their IRA before. So it could be an individual, it can be an institutional investor.
Yeah, and I appreciate Billy saying that. And the storage facilities are kind of like market resilient. You have death, displacements, downsizing, a divorce. You have all the 4Ds. That's kind of a everybody needs storage. Even in down
Absolutely.
market, they need
Right.
storage. They have to move their house. They can't afford it. They need storage. They buy a bigger house, but it's smaller rooms. They need storage. So it's kind of like a more of a resilient model in the marketplace, based on the tax incentives, based on what's going on in the marketplace. Storage is really a fantastic asset class.
Yeah. Yeah. Somebody
Yeah,
just, I'm sorry to interrupt
go
you,
ahead.
Darren. Somebody just asked yesterday, well, are you concerned about all these, young teenagers that are, turning 20 and 21 now? They're getting in apartments and they're not into, storing stuff and hoarding stuff like our parents were. And, back to Ben's point just a second ago, the 4Ds are death, divorce, dislocation, and downsizing. And will those, kids of today have those four things happen in their event at some point? Yes, you know. So I don't think it's going to never go away. I really don't.
Yeah. No, the demand. I mean, presumably it's ongoing, and it sounds like you guys have the expertise in the modeling that kind of identifies, what a market can sustain, or if a market has need for it, which would be comforting for that. Um, you mentioned some of the depreciation. Are you guys doing cost segregation
Yes,
studies? Is it?
correct. Yes.
Yes.
Okay. And then is the bonus depreciation, is that still, I know that was part of the original Trump tax plan back in his first term.
Yeah.
Did did those get
Back in now with
extended?
the, yeah, did
Or
with
is
the big beautiful bill. It's now
big
back
beautiful?
on.
Okay.
Yeah, that's
Okay.
it. Yeah.
Got it. Got it. So you get the bonus depreciation there, and that's great. So so an investor, they get in with 100,000, they're in, presumably how long until you start generating um any kind of returns? on that?
So we accrue. So the way we structure our deals, we do two classes of shares, Class A and Class B. The investors hold the Class A, and in that Class A, we also pay a preferred rate of return that accrues, and it's typically anywhere from 8 to 10%. And it takes us a year to construct it, and it takes about 2 more years of operations before we're actually cash positive, where we're paying the mortgage on its own, as well as the taxes and all expenses. So we say usually at the end of year three or the beginning of year four, we can start paying towards that accrued pref. And our goal is to sell these between 3 to 5 years. So let's just say 5 years as a window. By year five, they've gotten, some money between years 3 and 5. And then in year five, what we do is we pay off first their principal and then all the accrued pref and then their profits after that. So
And you have pretty high IRRs in cash and cash. Why don't you talk about that, Bill?
yeah, it's the IRRs are pretty high. They're north of 20%. Due to the SEC regulations, we can't really be talking too much or promising any returns, but they're north of 20%. And like any investment, obviously there's risks. I mean, we're all been investing for a long time. Anything can go bad, but we love self-storage for the reason that if you pick a good location and you have a good operator, the difference between this and multifamily, give you an example. I've invested in multifamily. We've owned multifamily deals. If somebody doesn't pay you your rent, then you have to go through the eviction process, right? That's different than what we have to do here when you have self storage. For self storage, it's a whole different process. A month later, you lock them out. They don't pay you. You auction their stuff, and out the door you are. If you have to evict somebody from multifamily, it could be a year. You finally take possession. Once you go in there, the whole place could be destroyed. And we have 900 units, right? So even if we lost 10%, 90 people moved out in a month, which doesn't happen. But if it did, it's not going to kill your portfolio, where in multifamily it does, right? Because you're getting $100, $150 a month rents in one unit versus in multifamily, you could be $2,000 a month, assuming you can get possession right away. So the risks are really mitigated in that. But back to Ben's point, good IRRs, and we can talk about the pref rate, which is between 8 to 10%.
Yeah. Now the ease of you know getting somebody out is definitely attractive as opposed to the whole eviction process with multifamily or any kind of residential property. Just the timeline and how the laws are in favor of the tenants more often. Um, with with that, I am kind of curious. Is there a break even point occupancy wise that you typically see where you mentioned 2 years where things start to gin for servicing the mortgage and ability to pay the investors. How much does that represent as far as occupancy? Is that a 50%, 70%? Is there a target point where you feel like that starts to make sense?
Yeah, right now, I would say 67% based on the assets that we have now. So 70% is a great benchmark. But really, to be honest with you, Darren, that really depends, right? If you're building California and the building was $20 million versus $15 million in the Midwest, obviously you have a bigger mortgage to pay, and your break even might be higher. However, the flip side of that coin is you should be getting higher rates in California than you are in the Midwest.
Right.
So all things being equal, I would say about 67%. And you should hit that, by the end of the second year of operations.
Got it.
It's project by project basis,
Yeah, it
absolutely.
really is.
And
Right.
any land anywhere, right? If you have a land in Arizona, it'd be different in Hollywood.
Right.
It's
Your land
different.
costs, of course.
Right. Right. So you buy, you build, uh, you exit. What's a or how many of these have you gone full cycle on in the time you guys have been doing this?
So in self-storage, because keep in mind we exited from the car washes in 2021. So we did our first self-storage. We bought it in November of 21, opened the doors in 2022. So we're going to put that asset for sale Probably in the springtime. We just met with the real estate broker recently and we toured the property. The difference also between self-storage and multifamily is an example for the NOI. When you build a multifamily, and let's just pretend it's a a small building, let's just say 80 units, and you fill that up in 2 years, you could probably sell it in the second year once you stabilize it. Maybe you get to 85 or 90%. You said, hey, let me exit that. And the reason why is your NOI on a multifamily is a lot higher and a lot faster than it is in self storage. So, I'll give you an example. In my neighborhood, let's say a studio apartment goes for $2,000. And when we open up the door, I'm going to market it for $2,000. I might have a special the first month, but by the second month, you're at $2,000. It's different with self storage. For self storage, even if you're charging $2 per square foot, and that's on a monthly basis, by the way, so we're talking about $24 annually, you're not going to charge that from day one. The big REITs like Public Storage and Extra Space, they'll start it. I'm making this up. Let's say $1.20 versus $2. Then once they have you in there, 6 months later, they're going to give you a big increase. Then 9 months after that, they're going to give you a big increase. On the first increase, some people may leave, but you have more people coming in. So the NOI takes longer to ramp up. That's why we say 3 to 5 years. So this one that we opened up in 2022, we're going to put it on the market in spring of 2026. So it's right at that, cycle of the 5 year mark. Actually, it's going to be 4+ years. The second self storage one we did, we exited that one a lot earlier. And the reason is we had another developer that was already in the marketplace that owned a bunch of these. We were developing for Extra Space, and we were able to sell that a lot quicker. So we haven't exited more than just the one, only because we got into it in 21, 22, and they haven't gone through full cycle yet.
Got it. But you did exit the one. Is that
We
correct?
did because,
Okay.
my next door neighbor sold his house, and I was surprised that he sold his house. I'm like, I didn't even know you were selling the house. He goes, I didn't either. Somebody knocked on my door, gave me a crazy amount of money, and I told my wife, let's take it and go. So that was what happened to us. Somebody
You
came
know,
to us.
our projects, well said, Bill, by the way. Our projects are really good because we analyze them so well. I mean, even we're doing one in Chicago Ridge right now. We get people asking, what's going on with the property. They're talking about certificate of occupancy when we build it to sell to them immediately. So there's so much demand out there, right? And the cycle can be as fast as we want it or as slow as we want it because you gain more money, depending on our own investors and how long they want to hold them to, right? So we can hold them for 20 years and then sell them or lifetime, and retire off of it. It's kind of like a 401k holding a self storage. It really is. So when you see a self storage people out there, think about like a cash station. That's what it is because cash comes in every month and you're making a lot of money on it.
Got it. Got it. Hey guys, if we could, I'd like to shift gears here for a second. As I've mentioned earlier, by day I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, supply chain, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Bill Kanatas and Ben Salzberg, what is the biggest risk?
I look at two different risks. One as an investor slash investment, and one is a developer slash development. So if we're talking about the development aspect first, because as I mentioned earlier, Ben and I spend our money up front first before we go to the investors looking for their money. We do a lot of work up front to mitigate that risk. And in any development, nothing ever goes perfect. As much as we think it's going to be great, it's not going to rain tomorrow, we're going to have sunshine. for 3 weeks, and the bulldozers will be out there, and all of a sudden we get rain for 3 weeks, and the holes we just dug flood, right? So you got to be able to have that in your underwriting, right? So when I tell somebody it's going to be 10 to 12 months, I underwrite it 14 months in case we have an additional 4 months of interest reserve or operational losses. So we try to mitigate all that risk up front. When you're looking as an investor slash investment, then, the advice I always give to my own friends is look at let's start with the development team, right? Do they know how to develop, whatever it is? Is it a Starbucks? Is it self-storage? Is it car washes? Make sure you're right with the right development team. Make sure they have experience, obviously. Make sure that you believe in the area. Is there a reason to put one in Boise, Idaho, or is there one to put one in Manhattan? Is there a demand for self-storage? And then who's operating it? Is it the Bill and Ben show, or is it, an operator who knows what they're doing? Is it the first time they're operating, or do they have, billions of dollars of annual revenue in this space? So I think there's various checklists to kind of mitigate that risk. And then at some point, you got to say, I'm all in and dive in, and know that if there is any problems, your partners will communicate that with you, right? Because it's very, very important to always have communication, with your lender, with your investor, with your general contractor, with the village. Ben's an elected official. And when you're working with the communities, you have to perform. You can't tell them one thing and do something else, right? So communication for me is always the best.
And I agree with you on that, Bill. Making sure the constituents in the area, which are mine, and that they like what we're building and developing in the community, and to mitigate that risk of any type of fallout of people being frustrated, being built self storage in their neighborhood. That's that risk. And of course, then there's, you want to make sure that the job is insured in case somebody gets hurt. And that goes with you, Darren. You have to, PNC, make sure that everybody's covered.
No, well said. Definitely, the risk is far and wide, and you gotta, identify it, and I like the communication aspect. I think that's probably the thing that I've recognized most is, bad news is a lot easier the sooner it's known rather than let it mushroom and get legs there. So well said. Hey guys, where can the listeners go if they'd like to learn more or connect with you?
Well, you can go to our website, self dash or hyphen self storage developers.com. So self hyphen storage developers.com. Or you can go on the camera and click on that little barcode if you're on a YouTube. But again, www.self storage developers.com.
Got it. Well, Bill Kanatas and Ben Salzberg, I can't say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you,
Awesome.
Darren.
Thank you, Darren. We appreciate you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.